Hello guys, this is Joseph Mshai the trader. I hope you have been doing well. I'm back with another video whereby we are looking for the number two setup. We have done number one setup about liquidity, and then we are here about now talking about now the setup, combining it with a price action and combining it with the moving average. So on my screen, there is a 200 moving average with a green. This is a 200 moving average, and this is 20 moving average. So one thing about the moving averages is that we usually move with a trend. They are trend following kind of setups. So meaning that when the market is below 20, it means that the market is strong down, no matter what the time frame it is. When the market is below 200 moving average, we say that the direction of the market is downward. But again, you have to know where are these demand areas and supply areas. So one thing is that you have to know that the market usually goes on high, lower, low, goes on lower, high, goes on lower, low here, because it has broken this low, so meaning that this is the lower low, and then again this is a lower high, and then we move on a lower low, and then we move on a lower high there, and then we move on to the lower low, you see. So then we have broken the previous high, this one. Yeah, we have broken that one, and then we came to this is a very important zone, because this is where the supply area is. In that area, you see, this is drop, base, drop, you see, that is a supply area. So others call it resistance. Where there is a demand, people usually call it a support, you see. But now, according, because this is just a moving average setup, it means that the market usually goes on lower low, lower high, lower low, lower high, lower low, lower high, lower low, and lower high. And now, this is how the moving average usually mean that when the market is below 20, it means that the market is strong downward. And then from this place, we shall be looking for the price action. And the price action usually says that when there is a bearish engulfing, if we are moving on lower low, lower high, lower low, it means that we need where the sellers are taking out the buyers. And one thing that you can be able to identify is that below the 20, let me remove this kind of, we have just deleted, let me delete this one. So this one, and now you can be able to see if you can come from this area. And then one thing that you know is that the direction of the market is downward, because the market is below 220. So once we came to this area below now 20 and 200, we need to look for bearish engulfing. But where are we looking for bearish engulfing? We are going to be looking for bearish engulfing at when the market move on lower low, lower high, at the moving average, you see, above or below. So one of the setup is that that if you want to enter with a price action, look for bearish engulfing. That is maybe is below or close to 20 moving average. And then when this market when this bearish engulfing cross the 200, you shall be having your entry just here, and then you just put the stop loss just above it, and then you can be able to target your ratios. It can be 1:3, it can be 1:2, it can be 1:1, according to your preference, you see. So but we recommend that, because this is a trend following strategy, or even or maybe a setup, you can be able to target 1:2, 1:3, 1:4, even 1:5. You can be able to target it. So you can be able to say lower low, lower high, and then the market, because now this is a bearish engulfing, is very close to 20 moving average, then this is just another entry. You just enter here, you see. So once you enter there, and then you just put the stop loss just above that price, just above that bearish engulfing, you see. Then we go on lower low, lower high, you see. And then all we need to do is for the bearish to come in. So if there is no bearish, no entry. So, and then it must be close to the moving average, you see. So it's lower low, lower high, lower low. Then we will be looking where the market is close to 20. So it has not given us any kind of a signs. But now you can be able to see here. Now the market went on high, then come on. This is not lower low because it is a trade within a trade. You see this one. So meaning that now the buyers they were unable to go up. It formed the double top. So meaning that that if they have failed to go on upward and the market is below 20 moving average, it means that where there is a close to the moving average, then you'll be looking for bearish engulfing. These are bearish engulfing. And again, the market went down. Then you can be able to look how the moving average is actually holding the market below. With whenever the market comes to the 20, it's pushed down. When the market comes above, it's being pushed down, you see. And now when we saw this bearish engulfing, there is this one indecision, and then this bearish engulfing, then we enter the trade, and then we put our stop loss just above it, you see. So why? Reason because we can be able to know the how the market moves. It moves on lower low, lower high, lower low, lower high, and lower low, lower high, and then we are going on lower low. Again, if you have been following my first setup, we usually say that the double bottom here, it means that there is a buyers who are buying here. So if you be targeting, you can target this low, or you can be able to target all the next demand area, you see. So it is from here. Don't know whether it's legible enough. So you can just look left and see that this is where the market actually started, you see. And then you can be able to see where our price is. Then it means that this market, it has a very high probability of coming to this demand area. So that is where we have put our take profit. So, and because it's a trend following setup, then we shall be waiting for our take profit just below. And you can see now we are just moving on well. And again, when our market start making lower low, lower highs, then we usually go break even, you see. We just want to take out, the risk out of the table, because now we are in the risk. But when we put the stop loss, the stop loss at the entry, then it means that we are out of the risk, you see. So the risk out of the table, we are just removing the risk. That our risk now, it is out. Let me pull them. Let me go break even. That way. So if we put our stop loss there, it means that even if the market comes against that, we are going to have a very minimal risk or no risk here. So that is what we call it the break even. And then we wait for our market to do what? To go down and down. We are going to be holding it down and down. And then we relax, and then maybe you can go and do something else. So this is how we usually have our setup. So we only look for, we usually use the direction of the market. You can use the lower low, lower high. And because the market is below 200 moving average, the direction is downward. We shall always be looking for sales, you see. And then after looking for sales, then we shall be looking for where the sellers are stepping in. And the sellers are stepping in when we see the bearish engulfing. So when they step in, we step in with them. When the big boys are stepping in, we are going to be stepping in with them. And you can see that our market is doing well. So let's hold and see how we are going to go now, how it's going to play out. We never knew, we don't know whether it's going to go to our profit, but one thing we know is that once we go on break even, it means that maybe because of the high probability setup, it means that we can go up to the take profit. It can take weeks, it can take like 2 days or even 1 day. So it depends on this market maker. So have a very wonderful, guys. If you need these kind of videos, you can be able to comment there, so that I can be able to know, and so that I can be able to be making this kind of the videos more oftenly until you become successful in forex trading. So have a very wonderful time, guys. See you, and I am out. Bye.